Well, with so much focus on the Magnificent Seven, investors may be looking beyond mega cap stocks to help better position themselves. For more, let's welcome in Luke Kawa, UBS Asset Management Asset Allocation Strategist and former colleague of mine at Bloomberg once upon a time. Luke, everybody keeps talking about broadening beyond big tech, but they can't stop looking at big tech, and until we started to get these numbers, that was borne out by the ramp that we were seeing in those stocks.
Yeah, I think it's certainly been the case if you look to why these stocks have had a lot of success. It's just a great amount of earnings growth in excess of the broad market. And it's been an environment where this has been the waiting for Godot recession, right? We've been calling for recession for the past 18 months and not really had those fears realized. If you think you're heading into an economic downturn and one never happens, well, that means to us there's a lot more room to have a refresh of the business cycle, to have a lot more breadth in terms of where profit growth is coming from. And I think you can start to see tentative signs of that in things like today the new orders component of ISM manufacturing, it went above 50 for the first time in 16 months, suggesting that finally we're going to see inventory restocking, that build out a little more. That's more things you would associate with the industrial economy. That's more something you would associate with cyclical sectors doing well. I think in the near term, we really do will be focused on these earnings and as well how the U.S., whether there is a policy response, what investors' thoughts are on this little banking kerfuffle that seems to be happening in regional banks again. In Q1, I feel like I'm having deja vu. Yeah. But those will certainly be factors we're watching in the short term.
And Luke, does the market have to broaden out beyond mega cap tech? I mean, obviously that's a trend we've been talking about, but does it have to broaden out if it's going to keep rallying to the upside?
So does it have to? No. Yeah. And that's just by virtue of the weight that these names have and the extent to which earnings have grown faster than the rest of the market. So for instance, if you're looking at measures of advanced decline lines, how many stocks are rising versus falling, those pretty much peaked late last year and have been edging lower. So the reason we've rallied even this year so far has been a much more concentrated story. And don't get me wrong, beyond the broadening out, we still maintain exposure to this theme. We're still overweight U.S. tech, but the view here and the thinking here is if we look at this medium term in terms of what kind of things can drive a lot of earnings growth. Last cycle, tech was able to drive a lot of earnings growth just because nothing really grew, right? This time, I think we have more of a catalyst, and I'm sure Dan has a lot more insight as to what AI might be able to do down the road. Our view is more just that the build out of AI and companies are looking to implement and see what can be done. That's a pretty big catalyst to kind of lift all tides in tech for quite a bit and empower a good degree of earnings outperformance.
I mean, it's interesting because you wrote in a recent note, this is a little bit of a different flavor than we have heard. You talked about mid caps. Now, we've heard a lot of people talk about small caps recently. Mid caps has been less, at least discussed. So what is it about mid caps right now that you think is attractive?
So one thing that in the mid cap versus small cap distinguishment is your choice of index is going to matter a lot. And I think the small cap index that folks would tend to focus on a lot, the Russell 2000 index, that's very growth oriented. That has a lot of companies that are more built on the expectations of perhaps major profit growth one day rather than anything they're doing consistent on a small scale today. Mid caps are the area where you're getting companies that do have proven track records, do have proven businesses, and in our view, it's more leverage just to the U.S. economy versus small caps. There's really a lot of leverage to biotech, which you can have a view on biotech. We have a stronger view just on the U.S. economy and the high likelihood of a soft landing, and the idea that a lot of the headwinds we've had over the past couple of years in terms of rates being high, interest rate sensitive sectors being squeezed, a long pulling forward of spending on goods that's been in decline. We see signs of that really reversing this year, and that's the mid caps really just fit the more ships rowing in the same direction type of vibe.
And Luke, after just the rally we've seen in the market so far, how does valuation look to you at these levels?
So valuation, it's one of the three pillars of our investment process. It's obviously going to be something that you care about. For us, it matters a lot when getting into strategic asset allocation, setting up portfolios for the very, very long term. But as I'm sure you know, and folks have gone on and said, in the short term, over the 3 to 6 to 1 year time frame, there is really no relationship between valuation and the direction of returns. What valuation can do, and what rich valuations today do say, is that the likelihood of very strong returns in the near term has gone down. But the most important thing, if you just get one thing to look at to determine whether stocks are going to go up or down over a 3, 6, 12-month horizon, it's what is happening to earnings estimates. As long as those are rising, your hit rate on stocks going up is very, very high. And based on our view of the economy, which is still a quite positive one, that's the environment we expect to persist.
And Luke, just quickly, I would be remiss if I didn't ask about the Fed while you're here, given that we just heard from Jay Powell yesterday. Were you surprised to see him say what seemed like pretty definitively that March is not happening?
Oh, quite frankly, yes. That did come as a surprise to hear, and it did come as a surprise to hear, so late into a press conference where, that would have been a headline that everyone would have appreciated a lot earlier. We could have tuned off and not golf season, and I'm not a golfer, but done something like that. But bigger picture, our view has kind of been, if the Fed is cutting in a month that starts with MA, and they're cutting because of good reasons, not bad reasons, good reasons being the fact that inflation on higher frequencies in 6 and 3 month is basically at target already. Labor market has normalized a lot, but is not deteriorating. As long as you're getting cuts for good news reasons, we're not too fussed about when the timing of that is.
All right, a month starting with MA and for good reasons. That's the target.
Yeah.
Yeah, Luke, thank you so much for joining us today. That was great.
Achievable, maybe, hopefully.
Appreciate it. Thank you, Luke.